Coming up on Market to Market. Congress and the President work to keep America from slipping over the fiscal cliff. The Environmental Protection Agency denies requests to waive ethanol production mandates. And wind energy proponents explain why tax incentives are crucial for future development. Those stories and market analysis with Darin Newsom next.
Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success. This is the Friday, November 16 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. U.S. consumers cut back on spending last month, adding further uncertainty to an already questionable economic outlook. After 3 consecutive months of improvement, the Commerce Department reported this week that retail sales fell 0.3% in October. Auto sales were off 1.5%, reflecting their largest decline in more than a year. And stripping out the volatile transportation sector, sales were unchanged. Equity traders reacted bearishly to the report as the Dow, the S&P 500, and the NASDAQ all trended lower on the news. Wall Street's reaction is not surprising, given that consumer spending accounts for nearly 70% of economic activity. But the trade also is concerned about Washington's ability to avert looming austerity measures known collectively as the Fiscal Cliff. Without congressional action, hundreds of billions of dollars in tax increases and spending cuts automatically take effect January 1st. President Obama and House Republicans returned from the elections this week, pledging to find common ground and keep America from slipping over that fiscal cliff.
Thank them for their time. I think we're all aware that we have some urgent business to do. We've got to make
As the
sure
country
that
teeters on the edge of the
taxes don't go
fiscal
up.
cliff, a nation waits for members of Congress and the White House to craft what is being referred to as the grand bargain before midnight on December 31st.
I outlined a framework that deals with reforming our tax code and reforming our spending. And I believe that the framework that I've outlined in our meeting today is consistent with the President's call for a fair and balanced approach.
Both sides of the aisle are offering their versions of how to avoid $500 billion in tax increases and $109 billion in spending cuts, and increasingly the calls for action are being made by party leaders and their surrogates.
The country has an extraordinarily difficult set of challenges facing us over the next couple of months. The election's behind us and we're ready to get started.
But I want you to be disabused of any notion that there's any widespread thought that it would be a good thing for our country for us to go over the cliff. We want an agreement. We want an agreement.
Despite the deadline being little more than 6 weeks away, partisan differences remain. President Barack Obama would raise taxes on households with annual incomes over $250,000, while Republican leaders insist that federal deficits must be restrained through spending cuts. Democrats are willing to put more restraint on spending as long as benefit programs like Medicare and Social Security are protected. Republican leaders say they could accept some increases in tax revenues, but only by trimming deductions and closing loopholes. Either way, if the cutoff date is reached without an agreement and the situation remains unchecked, a recession could result. While Medicare and Social Security are caught in the crossfire, the $500 billion farm bill is also getting swept up in the fray. Radical cuts to farm programs are expected to be met with calls for reductions in social and nutritional programs, which account for the vast majority of Agriculture Department spending. The looming debt crisis, however, may help get the farm bill a step closer to the president's desk. While the hard deadline is rapidly approaching, congressional vacations for the Thanksgiving and Christmas holidays slash available time for compromise to just 12 working days. It remains to be seen if Congress will be able to pull the nation back from the edge in time.
Wall Street pulled out of a 3-day slump after President Obama and congressional leaders expressed their confidence in their ability to strike a deal averting the fiscal cliff. While the players offered few specifics on how they will avert the massive package of tax hikes and spending cuts, the solution will likely be implemented in 2 phases, with steps now averting the fiscal crisis coupled with promises of broader tax reform in the new year. The optimistic developments were welcomed on Wall Street Friday, where all three major indices rallied dramatically on the news. But other announcements in Washington this week were decidedly less popular with some constituencies, especially a controversial Obama administration ruling on ethanol.
The Environmental Protection Agency announced Friday that it is denying requests from a handful of governors to waive production requirements for corn-based ethanol. In a statement Friday, EPA officials said, "We recognize that this year's drought has created hardship in some sectors of the economy, particularly for livestock producers. But our extensive analysis makes clear that congressional requirements for a waiver have not been met and that waiving the RFS will have little, if any, impact." The Renewable Fuel Standard, or RFS, requires that 13.2 billion gallons of ethanol be produced annually by the end of 2012, and the mandate increases to 15 billion gallons by 2015. Arkansas Governor Mike Beebe petitioned EPA in August to waive the ethanol production mandate, saying it was taking a terrible toll on animal agriculture in his state and that consumers would pay more as a result. Governors of North Carolina, New Mexico, Georgia, Texas, Virginia, Maryland, Delaware, Utah, and Wyoming joined Beebe in requesting the waiver, along with some members of Congress and a coalition of farm groups and other industries. EPA's decision to deny the waiver was cheered by the American Coalition of Ethanol, which said despite millions of dollars spent by big oil and big food to shamelessly attack American-made ethanol, it comes as no surprise EPA denied the requests to waive the RFS because the facts are on our side. But the decision was not well received in the livestock sector. In a statement, National Cattlemen's Beef Association officials said, in light of the most widespread drought to face the country in more than 50 years, the refusal to grant this waiver is a blatant example of the flawed policy of the RFS. The artificial support for corn ethanol provided by the RFS is only making the situation worse for cattlemen and women by driving up feed costs. This is the second time EPA has considered an RFS waiver request. In 2008, the state of Texas formally requested that ethanol production mandates be suspended. In both cases, EPA analysis concluded that ethanol production requirements did not impose severe harm.
Despite newfound optimism over averting the fiscal cliff, the rare display of bipartisan cooperation late this week will be tested in the days ahead. But make no mistake, change is in the wind, literally. A controversial wind energy production tax credit is set to expire at the end of the year. The credit was first authorized by President George H.W. Bush 2 decades ago. But some Republicans who characterized the credit as wasteful spending blocked its extension this past summer. The last chance to extend the measure now is in the budget deal that will be cut between Obama and Republicans in the lame duck session of Congress. And this week, wind energy proponents, including a few Republicans, explained why the $12 billion tax credit is crucial for future development.
Wind energy proponents took their case for extending production tax credits to Washington, D.C. this week. The Governor's Wind Energy Coalition, a bipartisan group representing 23 states, cited the need for keeping thousands of workers on the job as one major reason for Congress to renew the wind energy tax credit. The credit, which began in 1992, is set to expire at the end of the year.
Significant private sector investment in wind energy has occurred because of the support at both the federal and state policies.
Iowa ranks second nationally in per capita production of wind energy, with 20% of the state's power coming through the wind. Late this week, tech giant Google announced it will invest $75 million in an Iowa wind farm. With 7 of the nation's 10 largest wind farms, Texas leads the nation in wind installations, and the Lone Star State is also a major manufacturer in the industry. Iowa, though, has the most wind-related jobs.
We have literally thousands of wind energy-related jobs in our state, and in 54, I think, of the 99 counties, we have jobs directly related to wind energy. These are high-tech, high-paying jobs, and I remain hopeful that congressional action will soon enable more private sector investment and productivity in the wind energy industry to occur.
Iowa Governor Terry Branstad, chair of the Governor's Wind Energy Coalition, is asking for a 4-year extension of the production tax credit, that would in turn be phased out over that period of time. But with the clock running out on the possible renewal, Iowa's facilities have already begun to shed jobs. More than 500 have been cut in the Hawkeye State alone.
The uncertainty about the future of this tax incentive and others hurts the economic good that these policies do, and Washington should have learned the lesson given by the expiration of the biodiesel tax credit when it was allowed to lapse 2 years ago, and about 23,000 jobs were put on hold during that particular time.
Senator Chuck Grassley authored America's first wind energy tax incentives 20 years ago. The Iowa Republican believes that there is support for the tax credit in Congress.
In addition to jobs being lost, an important source of domestic renewable energy was hurt. The wind energy production tax credit is designed to level the playing field against coal-fired and nuclear electricity generation. The credit has been tremendously successful for renewable energy development and job creation.
The American Wind Energy Association says that wind energy manufacturing, construction, and operation provides 75,000 American jobs and has already generated $20 billion in private investments annually in each of the past 5 years. Wind energy has become a viable new source of power. According to the AWEA, 35% of all new power generating capacity since 2007 has come from wind. Despite efforts to rein in federal spending, Grassley pleaded for the winds of change not to blow on an industry that is still developing.
We have 20-year investment in this. It'd be terrible to throw away that 20-year investment if we can make it a mature industry, if it will be a mature industry within just a short period of time.
Next, the market-to-market report.
Grain and oilseed prices were pressured this week, with wheat prices leading the way. For the week, December wheat gave back all of last week's gains and then some, with a loss of nearly 50 cents, while the nearby corn contract moved more than 10 cents lower. Soybeans followed the grain south as the January contract settled with a weekly loss of almost 70 cents, while nearby meal prices declined by more than $25 per ton. In the softs, cotton broke through the $70 mark with a gain of $3.15 per hundredweight. In the dairy market, December Class 3 milk futures lost 50 cents, while the deferred contract moved 40 cents lower. Over in livestock, December cattle gained 40 cents, nearby feeders were off 15 cents, and the December lean hog contract posted a weekly loss of 43 cents. In the financials, the euro gained 14 basis points against the dollar, crude oil lost 40 cents per barrel, COMEX gold declined by $16 per ounce, and the Goldman Sachs Commodity Index shed nearly 3 points to settle at 637.40. Here now to lend us his insight on these and other trends is one of our regular market analysts, Darin Newsom. Darin, welcome back.
Good to be back, Mike.
We're glad to have you here. It's been a busy week. I know you've been running ragged, keeping track of everything that's happened.
Right.
Let's touch on some of the uncertainty that's going on in the broader market. What's driving these sell-offs?
Yeah, you mentioned it in the opening sentence of tonight's program. You had the word uncertainty, and right now these markets are largely driven by investment sentiment, and investors do not like uncertainty. They do not like volatility. They do not like the unknown. And so what we're seeing from sector to sector, financials, energies, metals, grains, we're seeing these traders getting out of their positions, and the effect on the market is, regardless of fundamentals, regardless of supply and demand changes, it's pushing the markets lower.
How long is this going to continue?
You know, that's a great question, because we can look at charts, or we can look at, any WASD or USDA report that happens to come down the river. Really, it goes back to Newton's first law of motion. I believe in it, that a trending market will stay in that trend until acted upon by an outside force, and that outside force has to be non-commercial trade or investment trade. So until they change their mind, we're going to see these trends continue. Until some of this uncertainty is solved, until they get a better feel or a better, wanting to stay in a market longer term, it's just not going to happen. We're going to continue to see this type of pressure until some sort of change occurs.
And it's not the good kind of pressure we're in. We're
No.
just going to keep trending downward. Let's talk a little bit more specifically. In the wheat market, broad-based sell-off this week, down 50 cents in the nearby contract. Is there anything specific we can attribute that to?
Well, it's kind of a fun game to play in the wheat market, watching headlines coming out of Ukraine. One day they're going to limit or they're going to ban exports. Next day they're going to be fine, and the next day they don't have any wheat to export anyway. So it just goes back and forth, and at this point wheat traders just simply don't care. Then you've got the southern plains, which is continued hot and dry or above normal temperature and continued dry situation. That's not going away. But all of these are known factors. All of these are fundamentals that have been built in. We don't know what's going to happen in Ukraine. We don't know what's going to happen in Russia. Yes, they don't have the supplies, and it should be just a matter of time before the U.S. starts to see some export demand pick up. We know that the southern plains are going to have a difficult time with the hard red winter wheat, but it's the fall and winter, and we're not going to be concerned about it until it comes out of dormancy in the spring. So all of these things are going to be shoved aside right now. Market's perfectly content to move sideways until, again, something develops.
And this sideways trade, what sort of prices are we trading between here, do you think, on wheat?
Well, in the wheat market, hopefully I have my prices correct. The Chicago December was right around that 846, and we took that out. Now, wheat's notorious for giving some sort of head fake, either going above resistance and then coming back down, or below support and coming back up. So what we're going to want to see is a sustained trade below some of these support levels, and if it occurs, then I think the market continues to drift down. In the case of wheat, yeah, I think it's going to continue to come down a little bit because, again, it just doesn't have that short-term fundamental support to be able to push higher unless we see something major happen on the export side of the market.
So for producers out there with some wheat left to sell, what's your advice to them? Do they try to sell here before we keep trending lower, or do you wait for that headline that's going to shock this market upwards?
You know, most of the wheat has already been sold. Just kind of the nature of the wheat market is the majority of it gets sold right off the combine or shortly thereafter, and then they don't wait around a long time to clean out the bins. Now what wheat is being held, I hate to sell it in a hole like this. There is the chance for a rally at some point, but seasonally the market does trend lower through November. So I think if you get a bounce back and you're just comfortable letting go and moving on, worrying about other things, maybe worrying about next year's crop, then yes, I think you go ahead and just let go of the wheat.
All right. Well, let's move to the other biggest mover this week in soybeans. We've seen another round of liquidation in soybeans all week long. Same story in soybeans?
It is even more dramatic than wheat, and actually it's more dramatic than what we've seen in most markets, because this is a market where long-term fundamentals are still quite bullish. You could still make the argument that by the end of February, mid-March, globally we're going to be out of soybean stocks. And we've got excellent export demand going on right now from the United States, yet the market continues to free fall. Why is that? Well, the CFTC report this week showed another 30,000 contracts, or roughly about 29,000 contracts, liquidated again from the non-commercial position. This has been an ongoing thing since July. It continues to gain momentum. We've now seen more than 33% of their overall position liquidated since that time frame. Fundamentally, there's no reason for the market to go down. But again, let's go back. It's not going to change its trend until these investors change their mind. Yes, we've seen some rain develop. Yes, we've got some better growing conditions now in South America, but that still isn't going to affect the market until say, mid-March, when those crops start to come in.
In the meantime, are there price levels out there that producers could watch for guidance? Any signs of support that you are tracking?
I've looked at this from a technical point of view, and right now you can kind of throw some numbers out there. We've got some retracement support around 1377. That's a retracement of the previous uptrend. We've got a trend line support right around 1372. If these are in the January contract, and if these price levels don't hold, market could come back to 1340, down in 1340, 1341 level. Longer term, could we see it even go lower than that? Some have tried to make that argument, but again, it just comes back to fundamentals. If at some point the fundamental or the supply and demand come back into play, it should provide support to soybeans.
So here in the soybean market, advice to producers might be hold on through this downward patch and wait a little bit longer?
Yeah, because it's still a market that I'm longer term bullish on. yes, we're talking about an 81 million metric ton production in Brazil, 55 million metric ton production in Argentina, but that's a long way down the road. So I still think we can see this market come back. The cash market remains firm. The basis continues to look strong. So I think this market could come back. It's just going to have to find some level down here where investors start to buy, because we've got commercial buying already coming in. Investors are just going to have to get interested in this market again at some point.
So producers wait?
If you're going to hold a crop, I think you could hold the soybean crop without, the risk reward right now seems to be in favor of holding it.
All right, let's talk corn a little bit. We had another sell-off in corn, same story going on there. Do you see this continuing in the same vein as wheat and beans?
The corn market has been pretty quiet. We've trended sideways now for quite some time. Only here the last couple of weeks we tried to dip down a little bit. We pushed through technical support in the December contract at 7.15 on Friday, bounced back with the news out of EPA. And the more I thought about this EPA news, my initial knee-jerk reaction was, okay, this is bullish, but maybe not long term. I think long term this is going to keep the question of, are we killing off this demand market? Because the weather situation is not improved going into the winter. It's not really expected to improve by next spring. And so coming out of the drought of 2012 and facing another dry situation in 2013, we could be looking at another tight situation in corn next year. And that means continued pressure on no exports, continued cutback in feed demand. This may not be the recipe that we want to start to rebuild demand in the corn market.
And that raises an interesting point for producers out there who are thinking about selling next year's crop. If your scenario takes place where we do continue to kill off feed demand and export demand, would it make sense for producers to begin selling next year's crop at the prices that are out there currently?
This is a real coin toss, because early estimates out there right now are 97 to 98 million acres. I mean, that's a huge number. And so if we have ideal weather and if we get the type of production, we're not going to get anywhere close to trend line. I think trend line yield is a farce anyway, but we're not going to get close to what's being projected right now. But if we see better yield next year, if the weather helps, we're going to have a great deal of supply. And that means if we haven't brought demand back, and it's going to take a while to get that demand back, we could be looking at rebuilding our surplus of corn. So there's a lot of ifs in that statement. If a lot of that doesn't happen, we're going to be looking at just as explosive of a market in 2013-14 as we did here in 2012-13.
So it is a coin flip.
It is a coin flip. I mean,
risk and reward on either side.
And the December contract is well below what we're seeing for these old crop contracts. So it's not saying it just really wants to be sold right now. But let's say we see the old crop move up. Let's say we are able to build some momentum going forward into the winter. I think then at some point we are going to want to pull the trigger on a little bit of our next year's production, keeping a very close eye though on weather developments.
All right. I'd like to talk a little bit about cotton. We saw a bit of a move this week, up 315. What's driving that?
Well, that was an interesting move. We've got all these markets where investment traders are getting out. I think they finally decided they've beaten the cotton market up enough, because fundamentally, you look at the global fundamentals of the cotton market, it looks relatively bearish. Now, the new crop cotton market, you can almost make a bit more of a bullish argument, because if there's going to be a crop that loses acres, it's going to be cotton. You're going to see acres, or expect to see acres increase in wheat, soybeans, and corn, and most of that's going to come at the cost of cotton. So we're finally starting to see a little bit of buying come back in, but the global picture is still so bearish. I think it's going to be limited on how much upside momentum we could build.
All right, let's talk livestock a little bit. Where do you see feeder cattle headed in the near term?
I don't look for feeder cattle to do a lot. I think both feeder cattle and live cattle are trapped in here right now. So similar to what we're seeing in the corn market, with a lot of sideways trends going on. Much of it could depend on the type of winter that we have, but I wouldn't be anticipating a huge move in either direction, in either feeder or live cattle, say over the next couple of months. I think they're going to kind of wait, see, feel things out a little bit, see what type of winter develops, and then move the market from there.
The cattle on feed report did come out today. Were there any surprises in there that you think is going to have any effect here next week?
I haven't been hearing a lot of talk about what's going to happen in the market next week, so I would not be anticipating, we've got a kind of a holiday chopped up week next week. It could raise the volatility a little bit, but I'm not hearing a great deal of reaction to this afternoon's report, or Friday afternoon's report.
People were expecting lower placements and lower marketings, and that's what they got.
That's pretty much what they got this time around.
All right, now as we move into the holiday season, where do you see hogs going?
Hogs have been interesting for quite some time. They've been needing to build some cash support, and we've actually got some commercial buying coming in. We've had a very nice little run up in the hog market. I think as we head into the holiday time frame here, this could continue. Hogs just seem to be building some support. Now, hogs being hogs, it can disappear in a flash. We've seen that happen so many times. But I would anticipate that, as we look at the DEES and the Feb contracts, that I think this market, could start to really build some momentum in here, could keep this rally that we've seen going. And if anything does start to help support the live cattle, we do know that we're dealing with tighter supplies. You add in the hog market, and I think both could start to build, maybe a little bit of momentum later on this winter.
All right, so perhaps some bullish news out there for producers.
We have to take it with a grain of salt because it is hogs, and they can change their mind so quickly.
All right, one of the things you mentioned a little bit earlier when we were talking in the grains, you mentioned the non-commercial interest in the grain market that we saw grow exponentially over the summer. Where are those non-commercials now, and what effect is that having on the market?
Well, you talked about how all the three major stock indexes were down, the NASDAQ, the Dow, and so on. We've got money coming out of the Dow. We've got money coming out of the grains. We've got money coming out of commodities in general. To me, it looks like it's a movement to cash right now. We've got support coming into the U.S. dollar index. There's more talk that the Federal Reserve is going to raise the Fed fund rate probably at some point in 2013. You've got the problems going on in Europe. I think, again, we go back to this question of uncertainty. Investors just don't want to be in quote-unquote traditional positions right now, and so they're going to move off into cash. They're going to move off into the U.S. dollar. They're going to look for something to play this interim until things calm down a little bit.
And how long can they afford to have all those dollars in cash? Is this something we could see for 6 weeks?
Most of them have had I haven't seen the numbers yet, but I would anticipate many of these funds have had a pretty decent year, depending on when they got into the markets and how bad they, how slow they were in reacting once these things turned. So they may be willing to sit out through the end of this year, see what happens with all of the U.S. economic talk going on through the December 31st, see where we are at that point, and then maybe start looking for those markets with fundamentals.
Great. Thank you so much, Darin. That wraps up this edition of Market to Market. But if you'd like more information from Darin on where these markets just may be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcast, and streaming video of our program, as well as links to our Twitter feed and Facebook account, all free at the Market to Market website. Be sure to join us next week when we'll examine efforts to keep Asian carp out of Midwest waterways. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success.